Ira Epstein of Linn Associates with your agriculture update. And this is for Tuesday, and we're at the 23rd of April, 2019, just after 3 p.m. Central Daylight Time. Another 15 cents lower in beans. Yeah, 15 cents. Look at the bean price, look at the dollar rise, look at what's going on in the stock market. And part of the story there, of course, is what's going on in pigs in China, the demand, the size of the South American crop, it coming onto a market when the Chinese crushers for the grains, they don't need as much soybeans from foreign imports because they've lost nearly 30% of their pig crop already. Now keep in the back of your mind, it takes about 114 days for gestation in a pig, and then you've got about 6 months to put the weight on the animal to get it ready for market. I'm assuming a 225, 250 pound animal. So you got quite a bit of time that's in there, and that puts back the demand for the old crop soybeans, which July is, and hurts its value. I'm just giving you some of the thoughts that is going around the industry. As we take a look at the weekly area chart of closes, you can see I've gone from 925 to this new low. And if you go back and you look at last season, your harvest lows, let's go from this November time frame in here, you've got a new harvest low close at this point. That's how the market would look at it. You can see how it's just literally fallen out of bed. And of course, the swing line has been correct in that it's had a pattern of lower highs, lower lows. It keeps dropping down. You're under key moving averages of the 18-day average of closes as well as the 100-day average. So where might support be? Well, that becomes the question because the market is now sliced through. This is yesterday. The market was trying to find support for 3 days at the lower Bollinger Band. It threw in the towel today. And the market just now in what we call one of these free fall modes where it's very hard to figure out where the next stopping spot might be. Are you oversold? You are, but you're in a downtrend. Literally everybody that is long in any position above today's close, which was right near the low of the day, a penny off of it, is what? They are losing. So it's the short open interest that is cleaning up on this at this point. In the meal market, very similar. We're back down to this area, as you can see, as the market's now trying to push through just like in the beans. It's not as clean a pattern because you had this higher high and a lower low. Now, yesterday, I am certain I used the word, unlike soybeans, this is running the lower Bollinger Band. I'd be surprised if I didn't say that because that's, well, at least I would mean it. And that's what's going on right now. You'll get a day under it, a day over it, but this is called running that lower band. Still a very bearish market. And in the soy oil, this is playing catch up. Notice how it's paying better attention to the Bollinger Band than the others. What happens is, what people do sometimes is a complex goes up or goes down in a big way. They'll look at one of the parts of that complex and say, you know, it didn't go up as much as the rest, so I'll buy it, or it didn't go down as much as the rest, I'll sell it and try to catch something. The problem is that part doesn't respond as much. Here you were down, for example, 63 points, which is about $360. You were down in the meal only 150, and in soybeans 750. So the market is playing games back and forth as to which part's going to be the weakest and strongest, and between oil and meal, because of the crush, this caught up a little bit today. That's the way to look at it. In the corn market, right on down to a new low for this whole move. And of course, back to the Bollinger Band, it did stall a little bit there, but that's all that I can say. It is respecting that number. We'll see how much it can respect it. And in the wheat, prior to today, you were under the Bollinger Band by yesterday. The day before, you were under that band as well. And then if you go to the day before that, the Bollinger Band was 451 3/4. We finished at 450 1/4, I believe. That was under it. This day was under it. So you had 4 days in a row. Generally, you don't have that fifth. You can have it. There's no magic to what I'm saying. These are just rules of thumb. We had a reversal. It doesn't mean it's a key reversal. You mark it when you look at momentum. Got both numbers under 20, both under 20, not both under 20 the day before. So the market's trying to correct, if you will, getting oversold, but it can embed tomorrow. And if it does, it means, to me at least, until it loses that, where both the red and the blue are at least 3 days under 20, it means that you should expect selling on rally attempts. If the red flips back over the 20 after it embedded, first it's got to embed. After, then I could make an argument maybe it gets even more short covering to a higher number. I don't see that yet. In the sugar, this is what you call the classic whipsaws. The market goes down, breaks out, tries to get traders short the market, comes back, goes up yesterday, goes up to the upper Bollinger Band, and then falls right back down today and plays around that 118-day average of closes. This is classic sideways action that is meant to do one thing. Traders are looking to see what the next direction is, and they haven't determined it. In the coffee market, we talked just yesterday, not today, how many times this market has gone up to this 18-day average and run into a wall. Well, today it dropped further. It closed a little higher, but it's not over that number. We had one shot back here at it finally getting over the number, and there was no follow-through. You just got to wonder where we're at this point. Are we going to one of these times say it's gotten too cheap? Some people are saying that Grow Coffee, the producers, that it's under their production cost. We'll find out if that's the case. But you do have a setup here that if this market, first of all, it's no longer in a downtrend. Let's say that. Second thing, if the market were to close up and over 94.63 tomorrow, I could argue you'd have higher lows, higher highs. The bias would be up and probably momentum turning up. It could be a signal that if it carried, the Bollinger Band comes potentially into play. If it doesn't carry and just gets another failure, you've worn out so many people, I don't think they'll give it a lot of time to grab hold one way or the other. In the cocoa, this has turned into a bearish market rout. You've just gone from these highs all the way down. It didn't even hold the 100-day average very well today. So it tells me that if it can continue down, if people throw in the towel, so to speak, the lower Bollinger Band, wherever that comes in, might offer the next support level. There's nothing that I see bullish on this chart other than if it drops a bit more, it probably gets oversold. In the cotton market, it's probably to a degree following the bean break. You've got lower highs, lower lows. Obviously, we don't have a trade deal with China yet. The question is, if you get a trade deal, do they need the cotton that we can grow? I can go on and on about that. The trend is down, the bias is down, and momentum is down. Next support zone, lower Bollinger Band 100-day average. Resistance back at the 78.20 level. To negate the pattern, you'd have to get back over 78.84. That would not turn the pattern bullish, but it would break the pattern of lower highs, lower lows. In the cattle market, what you've got is lost upside momentum. So as the market's drifting here, the question is, what does it do if it makes it back to what I call that line in the sand, the 18-day average of closes? If we look at the swing line, we can see that we've had the pattern of higher lows, and we certainly have had in the past the higher highs. Now, if you closed under tomorrow 120.72, I think you'd embolden the bears. The key for the bulls is to not let that happen if they're going to keep this pattern. And just breaking 120.85 puts the market sort of in no man's land for the moment. A close under 120.72, I would think, puts the market into a bearish trend, potentially could even wash out down to these levels. In the feeder cattle market, taking out 158.70 would negate the current uptrend that's got these higher lows, higher highs. The market ran into the problem at the Bollinger Band. Remember the Bollinger Band. The theory of the Bollinger Band is that 95% of the time the market will not trade outside of that band. So it got there a couple of days and then slipped back down. Now the question is, does it have the power to go back up? If I look at momentum here, I see both numbers are still over 80, and they have been that way today. They were yesterday that way, the day before they were that way, the day before they were that way. So it's 4 days in a row. That is still what I call embedded. If the red line gets under 80, and especially closes under 80, the odds favor that price and the 18-day average will make a run at each other. In the hog market, this is what I called a crowded trade. I wrote about it in my report last night and explained everything about the hogs. That's why I'm up to date and I can tell you how long it takes gestation and to get an animal ready for market. And what you've got here is the question of not does China need pork, not the question of will they buy U.S. pork if we can get a trade deal done with them. The question is, did the market get ahead of itself? That's how I'm reading it. And what I see here is a pattern of lower highs, lower lows. As I said then, and I'll say it again, when you get markets that have these kind of fundamentals tugging in one direction, the technicals in another, a lot of traders move to option strategies for the longer term fundamentals. I'm not convinced that the June hog's going to benefit anyway from whatever our deal is or isn't with China. It's the further back months that I'd have my focus on if I were watching the ag markets for that purpose. And where we discuss all this, and I mean we discuss it in detail, is in our Linn Associates research. We cover all the categories, if I can get the word out right, that you see right here, with an awful lot of emphasis on agriculture, the meat markets, what's going on there. You'll find that our expertise pretty good in these type of markets. Why? Because that's the nature of this firm that goes back many decades. So that comes together. Do we not have good currency and other information? I think it's great. I contribute a lot to it, so I'll pat myself right there. How do you get this information or try it out if you haven't seen it before? Well, number one, it's free to our customers. But how do you get it if you're not a customer of ours? Give us a call. You can go to our website, sign up for our free offers. And we made a change on our website page. I yesterday or the day before was talking about get our technical indicator to volumes. We fixed that. I thought it had been up there for a while. It apparently hasn't. We have taken care of that. So if you go to that page, you can now sign up for it right there. We'll get everything out to you. I'm Ira Epstein. You have a good day. Talk to you tomorrow.